Sorry, folks, just getting reorganized here. Well, welcome back, and thank you for toughing it out, but it's going to be worth it. This panel, the title is Resiliency in a Changing Risk Landscape. We originally, the title was Insurance, and what we found was that there's much more to this topic than insurance. And so we wanted to be sure to cover it all, which we are going to endeavor to do. Much the same approach on this panel as previous panel. Brief introductions by each of the panelists of themselves, their organization, and their priorities. And we will then, we have a number of questions and observations that we have that we will get everybody to talk about. I'm sure you've all seen the booklet with the impressive bios in the booklet, so I won't reread them, but to say the panelists are Pam Williams from FEMA, who you saw earlier today, Ray Farmer, to Pam's right. Ray is the former South Carolina Insurance Commissioner, and also the past president of the National Association of Insurance Commissioners, which is really important for the discussion we're about to have today. Jonathan Gonzalez, founder and CEO of Raincoat Insurance, based in Puerto Rico, but doing work throughout the country. And Raghuveer is going to forgive me because I'm going to hit his first name but not try the last. But it is Raghuveer from Munich Re, terrific guy. We've had lots of fun getting ready for this. And to Raghuveer's left, I went out of order, is Mary from the World Bank. You heard from her again. You heard from her this previous panel. And so we found as we were talking about funding that it crossed over into insurance, and Mary was kind enough to agree to do double duty as did Pam. So with that, brief intros, folks. Pam, would you start us off?
I'm still Pam Williams. And I didn't check my email thoroughly, but I still think I work at FEMA, head of grants. Thanks, guys.
Good afternoon. I'm Ray Farmer. I have been in and around the business of insurance and regulation for over 50 years, and certainly happy to be here. I sat in on the last panel, and it was extremely interesting, but I noticed each person had a headshot and their logo and so forth, and I was thinking, when it's our panel and my name is up there, what logo they're going to use, because I don't have a logo. I'm retired. But I'm the former director of the South Carolina Department of Insurance. I appreciate being here.
Hey everyone, I'm Jonathan. It's an honor to be here. It's my first time in Savannah. It's been absolutely lovely. So I'm a co-founder of Raincoat. Raincoat, we are a startup dedicated to developing innovative climate insurance products, kind of like what Mary mentioned in the prior panel. Oftentimes what we see with these types of deployments is that the last mile, or what's normally called the last mile, is one of the hardest parts. Like, how does the solution actually come together from a technical perspective, software perspective, and how do normal people interact with whatever the approach is? So we specialize particularly in that niche of that last mile and developing these insurance solutions.
I'm still Mary Boyer, and I do the things I talked about in the last panel, but also at the World Bank, I lead our engagement with the Caribbean Catastrophe Risk Insurance Facility, a parametric risk pool based in the Caribbean, and we support them with funding and operational support. And before that, I was working for African Risk Capacity, a parametric drought insurance agency of the African Union.
Sorry, we're allowed to share the mic. So good afternoon, everyone. My name is Raghuveer Vinukollu. I represent Munich Re US. I generally think of myself as a displaced hydrologist in the reinsurance industry who didn't know what to do really in the academic world. So I ended up in the reinsurance world, but some part of my mind is still saturated with the peril of flood. That's still a topic, some pun intended there. But really, my focus is hoping that we can turn the stormy forecasts into some sunny day financial insights. So hopefully that's what I could pitch about and talk about here today. Back to you, Al.
Thank you. This is going to be fun. In walking around the room and sort of talking to folks about what do they want to hear about insurance, what struck me is there's a lot of interest in insurance with not a lot of understanding about what it is, how it works, what's working and what's not working. And so to begin the discussion, what I'd like to do is to talk about various kinds of insurance from different perspectives. And then hopefully by the time we get down the line, we will have a sense of how it all fits together. So with that, Pam, again, sort of basic understanding of what FEMA does in the insurance space. What does it cover? What doesn't it cover? And if there are gaps, what are they and how do we cover them?
Oh, that's a lot. We don't have time for quite all that, but how many of you guys carry flood insurance? Oh, excellent, excellent. Guess who underwrites that? FEMA. Yeah, you might have gotten it through a Write Your Own company, but FEMA actually underwrites that. Guess what? You're not going to get a whole lot out of that. It's not going to make you whole. And guess what? If you're only carrying it on your structure, your contents aren't covered. I could go on and on and on. Flood insurance isn't going to make you whole, and if you aren't carrying flood, FEMA is never going to make you whole after a disaster. FEMA is your help of last resort. Insurance, folks. Insurance, insurance, insurance. So FEMA does a lot to try to help educate you and does a really lousy job of helping you understand your risk and helping you understand the value of covering your risk. I'm hoping that these guys can help join the community of helping everyone identify their risk, understand their risk, and how we're going to draw down that risk, and more importantly, how we're going to finance the drawing down of that risk.
Good start, which takes us to Mr. Farmer, who just so happens to know a little bit about insurance, having been an insurance commissioner himself, and having been the executive director of the group of other state insurance commissioners. So Ray's perspective on insurance and how, as Pam said, insurance, and how that fits with what FEMA does and doesn't do is critical. So Ray, please.
Certainly. As Pam said, FEMA generally writes every flood insurance policy in the country. One of my jobs at the South Carolina Department of Insurance and at the NEIC, the National Association of Insurance Commissioners, the NEIC, was to bring competition to that space. And we started it. It's a long slog, but and now in South Carolina and other states, the private market is beginning to enter and sell flood insurance. One of the bigger issues for the commissioner, for the regulator in South Carolina, was after the 2015 flood, the 1 in 1,000 year flood that devastated the Midlands all the way down to the coast, to what's the recovery part, as you'd expect. We gathered quickly in the parking lot of a shopping center at an affected area, and we had insurance companies there, we had FEMA there, and the gut-wrenching stories that came out of that. Most homeowners, even today, think, well, I've got homeowners insurance that covers the peril of flood. Obviously, those that raise their hand about flood insurance know that it does not. So the stories would be, this little lady came up and said, you know, my husband and I have been in our house for 32 years, and finally the mortgage company, you know, we got rid of that, so we got rid of that flood stuff. Surely my homeowner's coverage pays for our significant damage. No, ma'am, it doesn't. Story after story. And, you know, FEMA was there. FEMA doesn't make you whole. That was, you know, that was the theme of the entire flood recovery afterwards. So our job was to twofold: educate the consumers, and then I got a question from the press one day about, well, who should buy flood insurance? And folks on my staff just cringed when I said, well, if it rains at your house, you probably need to consider buying flood insurance. And that's true. Obviously, not everybody has to have it, but those areas that it really is not required, buy it anyway. It's going to be a lot cheaper than being in the flood zone. So our effort was twofold: educate and then expand the marketplace. You know, the NFIP insureds know that the rates are going up. You'll see the insurance industry come into that space and compete at some time. It's a very small market now, but look for that to grow.
Jonathan, your turn.
So, so one of the areas that we particularly focus on is this concept, right, of parametric insurance. And it was mentioned on the prior panel. I don't know if maybe it was mentioning earlier today, but just out of show of hands, how many people here actually feel like they understand what parametric insurance is? Okay. And how many feel that they didn't quite understand it very well? Okay. All right. Well, it's a pretty good distribution. So let me explain the concept at a high level of where the idea really comes from. This is going to be a bit of a strange metaphor. I'm going to try it and see if it makes sense. But imagine if I had a 6-sided dice, and every time that I threw the dice and it hit on a 1, a bunch of random animals entered your house and did all sorts of shenanigans for 24 hours. And that's just what happens every time the dice falls on 1. So if you were an insurance company and you were building a traditional insurance product, the way that they would do it is they would build a model of the types of damage that these random animals are going to do. And then they'd send someone out, right? And they'd inspect everything. And then at the end of that, they would debate, oh, no, the couch, I think, was like this before. That wasn't the cow, you know? And eventually they'll pay, right? And that's a traditional kind of process. Now, what happens if that's happening all the time, constantly, and it were happening to huge groups of neighborhoods where, you know, the dice hits 1 and now everyone has this issue? It becomes a problem and it becomes very slow, and by the time people get to recover, it might be too late or it might have taken a very, very long time, right? So the concept of parametric insurance is, rather than focusing on the animals, right, that were in the house that did all the damage, why don't we focus on the dice? And we say, when that dice hits 1, if we know that the average loss of this community, or the type of expected loss that this community would have, would be, I don't know, $10,000, why don't we just give them $10,000 as soon as that dice hits 1? And then hopefully that helps them recover quickly or in a more direct way, right? So that concept can be applied to all types of disasters, and it can be as complicated as you want it to be or as simple as you want it to be. It could be as simple as a hurricane that happens to be within a certain distance of a location, or it can be as sophisticated as the specific impact of wind over your location or the specific amount of water. And one of the things is, as we try to address kind of all the challenges of climate change, a lot of traditional products are starting to really get into the upper ends of issues of what they can actually do. And this is a very common problem, I would say, particularly in countries that have notoriously low insurance penetration rates already. So then how do you develop those types of tools? And then there's a lot of problems with these types of new and innovative products, because you have regulation that might not even be set in place to be able to deal with these types of products. How do they interact with government support programs that are already in place? There's a lot of questions, and in the US specifically, there's a ton of questions of how exactly these products get regulated, approved, and how do they coexist with the other ones.
We're going to go around and then come back around. Mary?
That was the best metaphor of parametric insurance that I've ever
terrific.
heard, and I'm so glad I did not have to explain it. But maybe the question I was asked in the last panel was some things in the Caribbean that could be applicable in the U.S. And one thing I left out that I'm glad I left out because it makes more sense here is CRIF, the Caribbean Catastrophe Risk Insurance Facility. It's one of 3 or 4 global risk pools, and it's the most successful, and it was the first. After Hurricane Ivan in 2004, Caribbean leaders came together and said, this is really terrible. This was over 200% of GDP in losses, and this happens roughly every 4 or 5 years. We need something because international assistance is not as timely and equitable as it should be. So they created CRIF with the support of the World Bank and some other technical advisors, and it provides parametric insurance for wind speeds, hurricane, excess rainfall, and ground movement or earthquakes. And national governments buy the products, and then they get to choose the parameters. They get to choose how frequently they would like to see a payout. If they would like to insure for just the hugely catastrophic storms, maybe greater than 50-year return periods, that's typically more cost effective. But governments also have this pressure of saying publicly, I'm buying this insurance, and then their constituents are expecting a payout. So there's also a political aspect where governments often purchase insurance to cover events that are more frequent than they should cover, leading to excess costs. That's a whole other conversation. But this idea of all the Caribbean countries pooling their risk makes the product super affordable, not just because it's parametric and it has no loss adjuster, and so the cost can be passed on to the consumer, but you're also pooling risks. And I'm not going to get into the mechanics of that, but you can just imagine that pooling all of your risk together is much more cost effective than taking your country and going to the market for a transaction. You're saving on transaction costs by pooling together 26 member countries instead of one. And CRIF over the last 15 years, and the CEO is coming tomorrow for the roundtable. So you'll hear him talk about this tomorrow if you're here, but CRIF has paid out over $350 million in the last 15 years, multiple payouts to Haiti for earthquakes, and these payouts all come within 14 days of the event. It's an amazing way for countries to access very quick liquidity. They've also developed products that cover the electric utilities sector, transmission distribution lines, as well as the fisheries sector. And they're looking at other sector-specific products to cover losses of really productive sectors of society. And we were talking before, there are the regulatory kind of hurdles that exist in the United States. They also existed in the Caribbean 20 years ago, but the Caribbean acted quickly and talked to the regulatory body and said, we need this insurance now, change the rules and make it legal for us to have parametric insurance. So things can be done to remove those hurdles, and you could envision a regional risk pool of communities along the East Coast transferring their risk. I mean, it's typically, you can model it that largely a hurricane will probably hit the East Coast once every couple years and in a different geographic location. I think it's a no-brainer.
Thank you. Thank you. Raghuveer, sir. I have a question to start you off with. We've talked about various kinds of insurance. FEMA, parametric, state. Munich is a reinsurer. What is a reinsurer?
That's a great question. So, well, Mary, I think you ended with, it's absolutely doable, and that's exactly what a reinsurer always thinks about. Everything is doable, but we really need to get things going. But let's get to that question. What's a reinsurer? Most of you might have heard we insure the insurance companies, right? And that's generally the next level within the insurance ecosystem at the end of the chain, where the reinsurers are insuring the insurance companies, basically helping them diversify their portfolio underneath, right? So for example, if an insurance company XYZ starts writing in Florida, right, or Georgia, all of a sudden they have too much concentration that for hurricane risk. Yeah, the regulators are going to say, how are you going to balance this with the amount of capital you have on the side to make sure that you're going to pay out the losses when it comes to that event happening? So that's when the insurance companies are like, well, of course, I definitely need to have a certain amount of money in the asset management portfolio and all of that so that I can pay off. But what if I diversify that risk and start writing a little bit in California, right? But to write in California, I have to remove some of my risk away, and that's when a reinsurer comes in and says, okay, we'll take some of the risk away in your tail risk, or we could also support on the side as a proportional risk. And that way, some of that capital is freed for the insurance company to diversify in a different region. So that's a simple way of looking at what a reinsurer does. But what people don't know is reinsurers have a much bigger role. And because our relationship with an insurance company is not on an annual basis only. Even though our contracts are annual, our relationship with an insurance company exists for decades. We have a company that we have been working for more than 50 years, the same reinsurance contract renewing. Of course, it changes a little bit depending on the portfolio growth. But I also think that the role of a reinsurer is almost like a sonar scanner into the future. And what does that mean? We really need to look into what are the signals that we can see in the future. Is it cyber risk? Is it AI risk? Is it natural catastrophes and especially wildfires, and adding in the climate risk into it? We rely on the fact that there is a diversification required for our business to work. We rely on the fact that there is no correlation between a wildfire in Australia versus a major hurricane in the U.S., in the Gulf, or a wildfires in Australia versus the wildfires in California and wildfires in Europe. But guess what? Climate change can actually have that correlation. So that's our role. We have to look into that future. And as Munich Re, we have been looking into climate risk since the 1970s. I wasn't even born, so. But I mean, I've seen the data, trust me. So, but yeah, so we really rely on this data and looking at and how do we incorporate this data and understand this data and make newer products, right? And some innovative products like parametric solutions or public-private partnerships. These are conversations we have to continuously have with our insurance clients, because ultimately, going back to my start of the conversation, an insurance company is really focusing on their portfolio for that year, right? They're not looking for a new product unless and until it's a stable product and it's something that will have a good market. That's when an insurance company will be more interested. And let me give you a best example, private flood, right? And private flood was something, when I joined the insurance industry in 2011, no one thought it was an insurable peril. None of the insurance companies did. So it's the reinsurers that backed the private flood and started creating the portfolio, creating enough data for insurers to think that it is an insurable peril. So now there is quite a bit. In fact, I think year on year, there has been growth of more than 50 to 60% in places like Florida. So I'll stop there. I know I can talk forever.
That's a good place to start. So let me follow up with you. As you look to the future, thinking about new, innovative insurance products to address a more volatile, problematic climate, what do you see?
Well, so let me connect back with some of the comments that I've heard from all the panelists here, right? And trust me, I'm really honored to join these esteemed panel because they make my life easy to communicate what we think. But there are 3 bullet points that come to me, to my mind, what we are always thinking about. And that makes insurance sexy, actually. Because insurance, I've asked this question to students in a classroom, in a risk business school, and who finds insurance exciting? No one. No one. And this is a risk management school, right? And so then I said, all right, well, there's a lot of examples I can give, but at the same time, let's change the terminology a little bit. How many of you actually think of insurance as a financial planning? Most of you would have, yeah, thank you. A few raised hands. But insurance is mostly bought, mostly sold, sorry, not bought, right? And no one wakes up in the morning and says, I'm going to buy insurance today. I would say, yeah, but a lot of people would say, I'm going to buy that NVIDIA stock or the Apple stock, right? That's doable. So, but the concept of insurance that we have to constantly think about, there's 3 bullet points. One is risk assessment first. We need to know the risk of today and tomorrow. If we don't know that, we've not even started the game, right? And then the point is risk communication and education, right, that our panelists have talked about. If we are not able to communicate the risk, we've heard the terminology 100-year flood, 500-year flood, how does it matter? If an average homeowner actually has a mortgage for 7 years, that's the average mortgage time period. Why are we relying on a 100-year time? If we cannot communicate the risk for the next 7 years, then we have lost the game. So then comes the risk transfer. That's insurance, by the way. So now it's a really cool term, right? Risk transfer is like saying, I have this risk, and it's almost like even if I'm managing the financial portfolio, I know that if I'm putting all of my money in the technology stock, I have a lot of risk if the technology world collapses, so I have to diversify that. So that's the same way. If my house is at a risk of flood, I really need to know whether I should live there, whether I should mitigate it, elevate the home, do something about it. Otherwise, I'm going to probably end up paying $50,000, and that's what insurance is for the unforeseen events, which our panelists, again, have told, right? So it's unforeseen, and of course, parametric solutions have also really evolved. But that's the thought process that we need to come to terms with, is like risk assessment, risk communication, then risk transfer.
Thank you. Jonathan, sort of back to you. You have an interesting micro product that I think in our discussions you suggested has been received more favorably and more quickly outside of this country than within this country. One, is that correct? And 2, why do you think that is?
Just funny, I was actually talking to Mary about this before on the outside of the panel. So I think it's been an interesting question that I've asked myself a couple times of why specifically has the U.S. Been so behind when it comes to risk transfer in the climate space compared to other countries or other regions that have been much more proactive in thinking outside the box and building creative things. And there's some aspects that have to do just with insurance regulation in the U.S., but taking that one apart, I think one of the reasons is that I think FEMA has a really strong brand. And I think, Pam, you mentioned it perfectly at the beginning. And the brand is so strong that I think a lot of people associate characteristics to FEMA and things that FEMA will do in a way that might not be realistic to what FEMA's actually supposed to do and how it's supposed to respond. I kind of call it the FEMA effect, where I have met with specific communities, municipalities, and when we're talking about things like risk transfer, in just passing, they're like, oh yeah, but FEMA will don't worry. Like if something were to actually happen, FEMA, the federal government would come in. So there's this sense that, you know, if something really bad happened, the federal government will come in and will resolve it. A lot of other countries don't have that as an option, right? So they know that if the really bad thing happens, that's it. The really bad thing happened and everyone is going to have to deal with it. And I actually think that forces communities and these countries to really get creative and innovative on like, okay, legitimately, how do we solve this? Because there isn't anyone else who's going to bail us out of it. And in a way, I think that's actually probably been the biggest kind of roadblock, is just how strong that perception is.
And Mary, what do you have to add to that?
Yeah, reflecting on that point, FEMA absolutely has a strong brand. But I think there's one more factor to that that's kind of unfortunate. The insurance penetration rate, property casualty insurance, are much lower outside of the United States than in the United States. So it's not as if individuals in developing countries are being innovative and purchasing insurance. It's expensive, you know, and if they're scraping by, you know, subsistence living, they're much more likely to self-insure than they are to purchase insurance. And self-insurance might be having a nutmeg tree, might be having, you know, plants that are going to help you subsist into your retirement. There's innovative ways that communities self-insure, not always through traditional insurance. But the one thing that the international community does have is international assistance that subsidizes premium costs for insurance products at a sovereign level. And so parametric insurance, in my opinion, has really shot off internationally because the member countries of entities like the World Bank and other global agencies see the benefits of insurance as a development priority. It's a way for them to get a multiplying effect on their impacts. If the United States can the United States or Europe or whomever can subsidize the costs of Haiti's insurance premium, and then Haiti receives, the insurance premium might be $4 million, and then Haiti receives a $30 million payout, bam, they can claim that as international aid. So it's a bit of a unfortunate, or fortunate, however you want to look at it, but the international community has allowed parametric insurance to really take off because it's been subsidized by so much international assistance that the United States just does not access.
Ray, how does this look to you from sort of the state insurance perspective? I think we chatted briefly, and maybe parametrics are picking up in the U.S. There's more value seen and more willingness to explore. What do you see? So
the parametric coverage itself is certainly not new. It just hasn't matured a lot in this country. It's coming. You'll see, you know, Mary's talked about it, and you'll see other instances, and Jonathan, of where parametrics is coming in. Several people in this room are part of the project that University of Georgia Nature Conservancy is doing to ensure salt marsh. They're in the initial stages of that, but that will be a parametric coverage. Insurance in this country is regulated mainly on a state-by-state basis. We've got 56 jurisdictions, the 50 states, DC, and the 5 territories. You have, I used to refer to them as 56 prima donnas that are regulating the business of insurance. So when a company comes in with a new product, they've got to go state by state to get that approved. You know, we were proud in South Carolina to reduce the time that a company had a new product or a new company coming in from a year's time to less than 30 days. It's up to the regulator to be innovative, to be creative, and so we looked for those companies that had a new product or a new project they wanted to bring to the market. Here again, it's still, you've got to go to each state to get all of that done. There's a commissioner in each state. There's a Department of Insurance in each state. And, you know, we come to our post differently. 12 of them are elected. The rest are appointed to some degree. South Carolina is appointed by the governor and approved by the Senate. And that was a process in its own. But that's another story for another day. But commissioners come, you know, with their own background. There's no requirement to be, you know, anything. There's those that are elected, some are even lawyers, for Christ's sake. But they come from different backgrounds, bring different perspectives, and that's the good part, because the commissioners meet frequently, and all of those backgrounds come together to discuss the issues of the day. But to answer your question, David, parametrics will be on the rise here in this country.
That's good to hear. Pam, there's a lot of discussion throughout these panels and just throughout the industry about the importance of mitigation and the impact that mitigation has on the availability and cost of insurance, whether it's FEMA, reinsurance, state, parametric. Help us understand what mitigation means and what it requires.
Well, and actually, you know, Ray has some great examples of what the state has done as well. You know, we have created a lot of perverse moral incentives in this country. It's really, I can't take credit for that term. I believe that term came out of Wharton. But it's beautiful. It rolls off the tongue, right? Like, it's really hard to get people to do the right thing. And I guess I really want to hammer home, while everyone may think FEMA's going to come in and save the day, what I hate is that no one hears those way after the fact stories. Those people hurt bad. They are never made whole. People lose their homes. People lose all of their belongings, and they don't ever get made better. And I wish that was the story of the outcome. Yes, FEMA may come back in riding on our white horse, but the story has a terrible ending. Yet we have created these perverse moral incentives that we never, and this country does not pay attention to things until crisis happens. And this is a non-sustainable system. Disaster costs and losses are going like this. The federal government can't in and of itself solve the problem. Private sector can't in and of itself solve the problem. So what are we going to do? We do have more resources ever on the table than ever before. So how can we work together to make these investments truly go toward the riskiest places, make those investments to draw them down? But I would love to hear it, because I do think that South Carolina did some amazing things on an individual basis, on a statewide basis, to start drawing down those risks. FEMA is really trying to get people to do the right thing, make investments before disasters, and that's what a lot of our grant programs are designed to do.
Thank you. So, Ray, I think we need to hear from you.
Okay, so another difference. FEMA comes in and supports the community, mitigation projects and so forth. Insurance is sold on an individual basis. You buy your own homeowner's insurance, you buy your flood insurance. And so what are the incentives to mitigate? In South Carolina, there's South Carolina Safe Home Program. There are several other similar programs throughout the country. I'll speak on just a second. But in our program, you would get from around, at the time it was around $5,000 to maybe $10,000. It's a grant. You would apply. We had it on the internet system, and we would open it up twice a year. Our problem, like your problem, is funding. We got all of the premium tax that was in our wind pool. We got 1% of premium tax statewide. So for us, it only provided $2.5 to $3 million a year. That money goes quick, even in small chunks of $5,000. It was need-based to some degree. It was economics was a criteria. You needed to get it to the people that could afford insurance the least. It'd go to things like roof tie downs, a new roof, or storm shutters, stronger windows, those kind of things that when wind blows, if the envelope is torn apart, if the roof comes off, the rest of it just goes right with it. If the windows come out, blown out, the rest of the house goes with it. It's been shown that fortified homes that have done a lot of mitigation, will withstand the wind a whole lot better than your normal building code home. We chatted about this a little bit earlier, there is a big lab in South Carolina around Richburg that the IBHS folks has put together. At the time, it was about a $41 million lab that's probably been there 10 or 15 years now. You know how the auto industry has a lab where they crash cars and all that? This is the same thing for houses. They have 103 gigantic fans on one wall. It will create a Cat 3 hurricane. We've seen houses that were built to code and then houses that were fortified. The code house, boom, just blown away. Obviously, it says something about building codes. But building codes are improving an awful lot. But if you take the extra step to fortify your house with a roof that's tied down, the shutters, the storm windows, the doors, and even your garage doors, mitigation will pay off. The insurance companies for even our South Carolina home program, you would see benefits of up to 25 to 30% in savings on your insurance premiums. Some states will mandate a percentage of a premium. We did not for savings. We mandated that they offer the discounts, and then we approved the discounts when they made their filings for their rates. Alabama probably has the best mitigation program going on now, where they have a lot more funding. North Carolina, South Carolina and North Carolina has what's referred to as wind pools, where companies won't write the wind risk on the coast. North Carolina's wind pool, when somebody has roof damage or needs a new roof, they'll replace the roof, period. That's a big mitigation effort that's going to, only time will tell how beneficial that was. But states and companies are getting creative, David, of how they approach things now, and indeed they should.
Thank you, Brad. That's terrific. Raghuveer, I know because we've talked about it, you have some pretty strong views on mitigation.
Right.
Would you share them with us?
Sure. And before I go there, I also wanted to connect some of the points about parametric but also the losses. In 2023, the amount of losses the United States incurred from extreme weather crossed $92 billion. That's according to NOAA. Insured losses from one peril, which is severe convective storms, was $58 billion. Just insured losses for one peril. Now, what does that number mean? From 2010 till 23, only 5 years have crossed that number in terms of insured losses. All perils combined. All perils combined, 5 years. And last year, we had only one peril which incurred. So just wanted to showcase because there is a lot of talk about what's the role of the insurance industry, and this is one way to bring resiliency to these communities. $58 billion of insured losses. If I put that number back to flood, because I'm a hydrologist, displaced for sure, but 2019 floods, right before the pandemic hit, over the entire Mississippi River, it was one of the longest historical flood ever. $25 billion of economic losses. But guess what the insured losses were? 200 million or less. So 25 billion versus 200 million or less. So that's another big gap in terms of the protection that exists in these communities. But then when we started talking to something like the Caribbean Catastrophe Risk Insurance Facility, we started talking to these states and said, if there is 9 states, excluding Louisiana and Mississippi, if we take only river flooding, can't we do a CCRIF kind of facility in the US? Absolutely doable, right? And then we were like, of course, but then that kind of has some challenges because of the Stafford Act. I'm not going to go into the details, but the challenge when we started interviewing the mayors of these 105 cities, one of the mayor was like, well, we did not have $10,000 in our bank account to rent a boat to transfer emergency professionals to the other side to mitigate the flood. We're talking about United States. A town does not have $10,000 in their bank account to mitigate some of the risk. So these are the kind of places where a parametric solution could be perfect, right? This is how innovation can help. And we know that, as Mary said, right, not every region will flood every year, but at least one region will flood every year. So that diversification, again, will help in terms of bringing these innovative products, which are risk insurance facilities. Moving to the risk mitigation, I would say just one project I would highlight. Again, after these floods of the Mississippi over the Missouri River, the Army Corps rebuilt a levee and put a setback levee. So basically moving back the levee so that the river flows more naturally at a pinch point of a river. Changes the standard of protection of the levee from a 50-year protection to a 200-year protection. We used that analysis and said, okay, which are the cities, which are the zip codes that get the benefit from this? 5 miles from the river, pretty flat land, 1,500 homes. We found that if all of those 1,500 homes want to purchase insurance, today we could offer them for $300 instead of the NFIP premium of $1,000. Why? Risk mitigation. Again, it's already done. Again, this is a nature-based solution. The levee, if we just ignore the cost of the levee, because the levee already existed, it needed to be rebuilt. What needed differently was a purchase of the land so that that land could be used for storage. It's a nature-based solution. You're changing the ecosystem, you have a lot of other benefits. But that costed them only at $3.5 million. And just the insurance savings for these 1,500 homes, from the $1,000 to the $300, would recover that $3 million within a matter of 4 years. So that's the power of mitigation. It pays for itself.
11-to-1 return on investment, 14-to-1 return on investment. That's National Institute of Building Sciences. That's not PAM data. That's real data, folks.
Ray, a question I hear a lot about and people read about is the availability and cost of insurance. And to the extent you can address it, our insurance companies declining to provide coverage, is coverage being priced because it's justified or as a disincentive to continue it? Where do you see all that?
A lot of questions right there. Great
I know.
questions, but it's availability and affordability. Is the coverage available? Is there a company that wants to write that coverage? There's no requirement that a company has to come into your state to write business. You try to make it, as a regulator, you try to make it as attractive because consumers benefit with more companies that we were able to bring in, the better off our consumers were. When I went into South Carolina in late 2012, coastal property coverage was a big, big issue, extremely big. And so our goal, here again, was to bring in more competition. We brought in over 100 companies, and timing was in our favor as well. I'm not going to take credit for all of it, but the more companies we had, the more available the coverage was. And companies compete. When you see a company come in Florida, they've made got a lot of attention for some companies pulling out of the marketplace. Insurance companies are in the business to write insurance. If they cannot make a profit, they will not write it. Just like any other business, shirt business. If they can't make a profit, they're not going to sell shirts. So some states come in and have more requirements, make it tougher for a company to leave. You make it tougher for a company to leave, well, that may be beneficial for a little bit, but that's also tougher for a company to come in. Why would you come into an environment such as that? But David, the main thing for a regulator is availability and affordability. At some point, citizens just can't afford the coverage, and that's true for a lot of other lines as well.
Thanks, Ray. I mean, that's really helpful. I mean, you hear a lot about what's going on, but you never really know. And again, sort of hearkening back to our previous panel, and if we look at insurance availability, affordability, and the impact on funding and financing, they tie together, because if things can't be insured, they will not be funded.
Well, also, just one more point. I think we're beginning to pay attention in this country where we build. You build on the blooming beach, it's going to flood at some point. There's going to a storm's going to come. So obviously it's preaching to the choir here, but we've got to be better at where we build, where we put people at risk.
Heather, how are we doing on time, kiddo? I want to be sure we do have time for questions. Are there questions?
Of course, Ashley has questions.
No, there are many questions. So please, sir.
Hello.
You need a microphone.
Thank you. That was a fantastic panel. I took down some questions, and I was midway writing my third question when we had questions announced, so I'll ask two, if that's okay. So we've talked a lot about, in this conference and in other conferences that I've been attending recently, about how there is this difficulty in the policy associated with permitting living shorelines. And there are technical challenges, obviously, and it's just a difficult landscape. I'd like to hear the thoughts of this panel on whether it's possible to use insurance pricing as a way to motivate policymakers to make it easier for homeowners to, construct living shorelines as a mitigative solution rather than, hard infrastructure, and what that would look like. Would that look like a carrot approach where you have some subsidies associated with installing a living shoreline, or would it look like a stick approach where you increase the insurance premiums if you don't have a living shoreline? Some thoughts on that. And then I have a question specifically for Mary. You talked about parametric insurance being pooled, and I'm just curious how that would, I don't have an insurance background, so if I sound very uneducated, please forgive me. How would that work when you pool across countries with, say, different developmental trajectories, and say a few countries are going very far ahead with the mitigation measures that they have in place, and a few countries are lagging behind? How would something like parametric insurance work in that context? How would you standardize payouts between these different countries? Just curious to that. Thank you.
Thank you. Lots of questions within the question.
Yeah. I would say the first question, I have to give it to Ray.
Yeah,
Yeah,
I think,
we were saying who got the privilege. I think it's Ray.
Well, we'll wait for this
I would
answer.
ask Ray, can we?
I didn't understand the question.
I think, so if I got it right, it was like, what sort of incentives can you build into premiums? Like, it was kind of the question I asked you earlier, like if you can decrease the premiums to drive behavior
An increase.
or
Sure.
increase carrots and sticks.
Yeah.
with
No,
premiums.
That's a great question, but you see it all the time in the insurance industry. Take, for example, auto insurance. You're a safe driver, you got students at home, they take driver's ed courses. You got the right things in your car to make them safer. Same thing for homeowners. You've got fire alarms, you got smoke detectors, you got security systems. Those things already exist. What the consumer, is up to the consumer and the way they buy the coverage through an agent or the company, needs to understand, needs to ask what's available. If I do this, do I get that? Do I get a discount? If whatever I do. So it's up to the consumer. It's really one of our jobs, we thought, to make sure the consumer understood what they're buying, what the policy says it covers, but more importantly, what it doesn't cover. Back to our flood example, homeowners obviously doesn't cover flood. Homeowners doesn't cover earthquakes. So you've got to ask those questions that fit your lifestyle, your home, whatever, your auto. How can I get this coverage less expensive? I didn't say cheaper, less expensive. Ask your agent. If you've been with a company for a long time, don't fall in love with that insurance company. You miss a payment, you have a lot of claims, they're not in love with you. So do your homework, educate yourself, shop. If I said anything a million times when I was the commissioner, shop around. For any type of coverage you get, auto, homeowners, health insurance, you're more limited, life insurance, sort of. We're not even going to talk about something called long-term care because there's a lot of horror stories there. But whatever coverage you buy, be your best consumer advocate.
Thank you, Ray. Pam?
So FEMA's really tried to build this into the community rating system. So this is kind of the foundation of the flood insurance program. So we really encourage communities to belong to the community rating system. And the better your score, the lower everyone's premiums are if you're buying flood insurance in that community. So and this is everything from education programs that the community is trying to do. It is community based. And so we really do try to encourage those regionally based projects, programs, mitigation to help draw down on a bigger scale that savings, right? Get everyone in the game, get that skin in the game. And in a lot of places, it works really well. But then when you don't do the right thing, you're about to see this happen in a couple of places in Florida, you get downgraded and premiums go up, and then everyone, I think, understands community politics. There's a backlash.
Thank you.
It also applies to homeowners and communities with fire rating. Closer you are to a fire station, closer you are to a fire hydrant, companies pay attention to those. Depends on what type of fire rating your community has. There's used to be a ranking of about 1 to 12. You got a volunteer fire department and you're 5 miles away from that, you're going to pay more. If you live right next to the fire station or you got a fire plug in your front yard, all that is taken into consideration. Back to your question, sir.
Thank you. Great question. Other questions?
I think
Raghuveer, you have?
About
Okay, I can try and answer it pretty quickly. But so from what I understand, you're asking how countries with different levels of development can be in the same risk pool. Huge concern for countries that are joining risk pools. For the Caribbean, it was a little bit less of a challenge because Caribbean is super very bound by CARICOM, and they're very tied together, very supportive. But still, you've got Haiti and you've got Barbados in the same risk pool. And they don't really interact. They each have their own policy, and their insurance is also priced differently. So the pricing models are made of your exposure profile, like your built assets, how residential and non-residential, and then hazard mapping, like the trajectory. If we're talking hurricane, the trajectories of hurricane, what's the likelihood it's going to go through your cities and highest exposure, then your vulnerability, how good are your building codes, how well are they enforced, what is the level of poverty in your area. And so everyone gets their own model. Barbados versus Haiti, Barbados has much higher risk because they've got the much nicer properties, and Haiti obviously has much higher vulnerability, lower like actual exposure values, like replacement values for built assets, and so they're just taken to the market together, and that's how they pool risk. Instead of 26 individual transactions, you've got one transaction with the reinsurer, who will say, okay, I've got all these policies, and then when an event hits one particular island, that only that one particular policy is enacted. Does that make sense? So, go ahead, please.
I'd also add that I think it's still risk-based. It's not, we're not just saying that it's the same price for everyone. It's still risk-based. Well, that's what Mary was saying. The exposure is absolutely assessed. The vulnerabilities are assessed. Now, if these, if we take the example of Barbados and Haiti, if they actually individually go and purchase a policy, that would be still more expensive than being part of the pool. So that's still an incentive to be part of the pool.
But if like Tybee Island and Cleveland are in the same pool, Tybee Island's premium was probably going to be more than Cleveland because Cleveland has a very low likelihood of being hit by a hurricane.
Thank you. Anybody else on this question? Great answers. Good question. Thank you. Other questions?
Yeah, so you made a comment earlier of the fact that possibly not every single county would flood every single year. And you've been talking about how you can possibly pool risks, you can provide different types of products. But my question is really, what happens when every single county does flood every single year? You're hedging a bet against the payout, but climate change is betting against your business model. So how is this private response to disaster sustainable in the long term?
Go ahead. Go ahead.
Well,
Trouble hearing you. Go ahead, Mary, if you can.
I mean, in technical terms, that's up to the insurance company to manage their risk. It would be pretty silly if they were to only insure or only have in their portfolio counties that often flood together. And so very likely they will diversify their risk and have enough in reserves that they will remain solvent for their biggest payout possible. And when countries choose, when anyone chooses parametric insurance terms, you choose an attachment point and exhaustion point, meaning you choose the lowest level of risk you'll pay out for and the highest level of risk you'll pay out for. So even if you get a 500-year event and countries have only insured up to 100-year events, you don't get any further payout. So it's not like the payout is infinite. It stops at a certain point, and the insurer, if they're responsible, will stop from insuring losses beyond which they are insured themselves. That's a very boring answer.
That's an excellent question. So, and that's really one of the challenges for climate risk, right? So we do have pretty sophisticated models to understand what the risk is. And that's why, as I said earlier, insurance is for the unforeseen risk, right? What parametric comes with an innovation product is now we are taking a parameter and saying what is your risk appetite as a county or whatever an entity there, and saying what risk can I take and at what point do I really need some help, right? As that trigger goes down, which is lower the attachment point, the more the parametric product behaves like the indemnity product. It's almost the same price almost, right? Because now you're saying you want a payout for almost all of the frequency losses. So connecting back to the climate change, which some of the risks which are increasing, and that's the challenge of insurance. We, by definition, is also a risk pool. As much as we diversify, the better it is, the cheaper it is, the more affordable it is. But also, we need to remove the frequency events. If some events are happening every year, that's not insurance anymore. That's trading dollars, right? So that is what makes insurance unaffordable. And so that brings to the earlier question about, I wanted to say, well, what Ray said, insurance companies are going to price their risk, and if it's not something that they can take, they will stop writing. But at the same time, I want to emphasize that the local communities actually have the entire liberty to manage your risk. You are empowered to manage your risk. And that's what FEMA helps with, the pre-break grants and so on. I mean, I don't see many countries that offer up to 90% of the federal dollars towards managing the risk, or building a wall, building marshlands, and so on. So how can the communities manage their risk so that actually the regulators have a better job of regulating the insurance industry, because their job is to make sure that the prices are still affordable, but they cannot manage the risk at the community level.
You can even partner with your insurance company to better understand risk by using all those sexy data models.
More questions, please?
Alex Butler, South Carolina Office of Resilience. That last answer really led to at least my question. How do we get the reinsurance data models to FEMA, right? So FEMA does a really good job of the backwards-looking firm maps. And reinsurance, by your own statement, is trying to take that forward-looking to look what's coming. So how do we get that information to FEMA so so people can make informed decisions, right? So it's not hidden behind some paywall.
Well, so
Yeah.
of course, I mean, we are, and I won't give specifics in terms of the cities and counties that we are working with, but I can tell you at least a handful of regions that we are collaborating with, along with some engineering firms that are doing the analysis, the resilience framework for these cities and counties. And an reinsurance company is coming over and saying, okay, based on the decisions that the city or county will make, what is the impact on the insurance based on the climate models that we have, the projections that we have? We are doing those the insurance impact analysis based on the decision making. And that's definitely, we also recognize that that's the kind of collaboration which we required, and Ray and I were talking about this a bit earlier, that the solution here is not to work in silos, it is to work across silos, having a collaborative effort. So yeah, we definitely are stepping ahead and saying we need to have a seat on the table, whether people like it or not, while these decisions are being made.
Thank you, Ray. Ray?
Yeah, and the use of models is common among all insurance companies. And as a regulator, when they come in and say, we want to charge X amount, here's our data, we look at all the modelers. Just like when you see a hurricane offshore and the weather people have all the spaghetti noodles up, models are the same thing, same way. This model is going to be different from that one, and so up to the companies, the regulator, FEMA, to kind of combine all of those models. Only one state that I'm aware of, Florida has its own model. They have, that's the best sign we've seen all day. 3 minutes left. Florida has their own model for their hurricane systems and rates. They update that model every year. Scientists, academics. I sat in a meeting one time with about 15 to 20 of them and going over the next year's rate. We had a senator in South Carolina said, okay, let's have our own model. South Carolina's an extremely small state. They backed down when we showed them what the cost was. To build the model was $8 to $10 million, but then you've got to have half that much to keep that model in place every day. That was a long answer to say a lot of people, the entire industry uses the models.
Thanks, Ray. Let's try to get a couple more in.
Okay, I'm just coming at this. I live in Miami-Dade County in a house that's over 60 years old, and this whole discussion about negotiating with an insurer, nobody will insure it, or it gets. I've probably had 10 different insurance companies. Every year it changes because it gets picked out of the state pool, gets some fly-by-night company or some quick thing, then they drop me the next year, back and forth. It's just totally flipped in an older home in Florida, in South Florida. So how do we, and obviously these are the, I have reasonable resources to try to fix my home. I have it wind rated, whatever, but it still doesn't help. And how do you help people that don't have the resources I have in these older homes get insurance?
We've been getting a sign that says we have 1 minute left. I think the panelists are willing to go longer if you want to stay longer. Maybe 10 or 15 minutes more? Okay, how many more questions do we have? I think there are a couple more. So go ahead and answer it, please.
Ray's in the hot seat.
Yeah, he is, yeah.
So, I do. Yeah, what's 10 or 15 minutes? I've got all evening. So your question really is the affordability of it. And part of it is shopping. You brought up a great point, though. I think I understood that every year you hear from a different company. They're smaller companies. You refer to as fly-by-night. Right. Oh, okay, and the pool you're referring to in Florida is Citizens. Years ago, when there was an insurance crunch, states approached things differently. Florida, Louisiana, maybe a couple other states formed their own insurance company. In Florida, it's called Citizens, and the volume goes up and down. Sometimes they've had programs for companies to come in and buy people out of the marketplace. It's competition again. So how do you buy your insurance? Do you use an agent, or do you on your own shop and investigate and call a company? Get a new agent. No. No. It is.
The bigger question I have, I'm not my own situation, but the bigger question I have is just how do we help people that have limited means be able to put their housing in a way that they can get their insurance affordable?
Okay, so there are some community efforts and some state efforts that helps citizens fortify their homes, such as the grants we talked about earlier. But in some states, South Carolina has an Office of Resilience. They have programs. They have grants. I think they were on the program here last year. There you go. Perfect. I talked to him. But obviously he'd be in South Carolina. But there'll be those kind of programs, that here again, it comes back to availability and affordability. We're pricing you know, people say, well, we shouldn't be subsidizing, or we shouldn't be worried about all these high-rise, expensive condominiums, all the big houses on the beach. Those were never our concern. Our concern are the people that work along the coast that can't move to another place, that have got to exist, have to make enough money to, you know, put food on the table and then buy it in insurance as well. Part of it is the regulator. The regulator controls more or less the cost that the companies charge. Part of my job was making sure that a company justified in whatever they paid. We would turn them down. They could go to a hearing in some lines. And so it's another community effort.
Thank you, Ray. Mary, you,
Yeah, I just wanted to give a very brief alternative perspective that doesn't necessarily apply to your personal situation, but perhaps those who do not have insurable homes or live in informal settlements or do not own a home. And Jamaica, St. Lucia, Grenada, Dominica have all purchased this policy from CRIF called a livelihood protection policy, where it focuses on ensuring the livelihoods of folks instead of ensuring their property. And so it is focused primarily on people whose work is impacted by disasters, and it takes into account when it's pricing, it takes into account their average livelihood, potential repairs to their structure, whether it's informal or, you know, not reinforced, not insurable, and it's purchases that the government makes, but it goes directly to beneficiaries, and it's a way for governments to transfer the risk of social protection to the international markets. Instead of making cash payments and cash transfers after an event, say for $100 to individuals, why not pay $10 in advance and then transfer the risk, pay $10 in premium, transfer the risk, and get a much larger payout. So this type of livelihood protection is a way that countries are addressing unaffordable housing or uninsurable housing situations.
thank you, Mary.
Yes, that's what I was just gonna say. The answer, yeah, yes. I think, I don't think I can offer a solution, but before that, let me say some of these are my own personal opinions, not representing my company. All right, I have to say that. Well, part of the problem in Florida is also other issues. It's not just the changing risk; it's also the legal risks associated, the AOB, the assignment of benefits issues, social inflation issues, and so on. And that, again, comes back to the question of insurance is a risk pool. We just have to manage where is the claims, how are they going to be adjusted. And so it's not just about the changing risk, it's also about the other issues, how they need to be managed, I would say. I'll just quickly.
And I'll add to that, that the problem in Florida has been coming for the last 15 years, and it just is now at that point. Legislation is now corrected.
Exactly.
There are two significant pieces of legislation corrected. So you're not going to see anything positive for a little while, but it is going to start moving in that positive manner because some of the political pieces that were put in place that caused the chaos got fixed. But you also have mitigation based on component-based things, which Louisiana then copied. Now they are in a dumpster fire like Florida. But they've also quickly learned. So there's a lot of issues in Florida that are not going to fix themselves in the
Yeah.
It's going to be a minute,
But,
it was created.
but if I may just offer a solution, and not to overcomplicate this, but again, I bring back to the point that your risk is better managed at your community level, and your community has the power to have the bonds and environmental impact bonds. There's a lot of other instruments that can mitigate the risk, at least to begin with.
This gentleman has been waiting patiently and still smiling. So one more. Last one, last one.
The World Economic Forum met last week about Disease X. I was a consultant with Munich Re and Metabiota for a pandemic risk insurance plan. It came out in 2017. 0 policies were ever purchased. Is that policy still available? Is Disease X something of interest to the insurance industry?
Yeah, I'm not part of that team, so but I think that team still exists and they still do a lot of business. So definitely that is something that, but again, that has its own challenges because the pandemic was still there till, and we didn't want some complications of which pandemic are we referring to. But those kind of solutions are always, and that goes back to my earlier point that we always look into the future. So that was a great example of saying we had this product, none of the restaurants, none of the small businesses bought it. But if they had, they would have recovered so well after that event.
Okay, panelists, thank you. Terrific, terrific job. Well done. And thank you all for being here and hanging with us.